Manish Jain is here with me today from Ambit. He's a fund manager at Ambit and handles the coffee can portfolio. Manish, good afternoon. Thank you very much for joining us. Talk to us about your portfolio. Coffee can portfolio is actually something which was designed earlier by your predecessors as a portfolio we could be kept for a very long haul. How's the composition looking now? Talk to us about the sectors which are represented in your portfolio now.
So when you look at coffee can, the inherent philosophy has kind of remained consistent in the last 2.5 years of its existence. And as you mentioned earlier, it's a portfolio which is meant for true investors, people who are ready to invest in equity markets through cycles, who are looking at wealth creation and not income generation, people who can remain steady and patient through down markets, down cycles, if at all use them as an opportunities to invest more, build up the positions from a long-term perspective. And from that perspective, the portfolio kind of remains by and large unchanged. We continue to be very, very heavily biased towards B2C names. We very, very heavily continue to be biased towards structural growth stories. So most of the sectors that either have a government intervention, most of the sectors that have external factor interventions, and most of the sectors which are cyclical in nature, which needs to be timed, are not the ones that we are invested in. So the core philosophy, the core ethos, and the pillars on which the whole fund is based on kind of continues to remain unchanged, irrespective of who's managing it and who's not managing it through times.
Right, Manish, you have housing finance stocks as well in your portfolio. HDFC, is the one. I don't want to call on the stock, but what did you make of the commentary from the management in the recent times? Even the HDFC twins now are coming under, selling pressure because commentary seem to be suggesting that probably some air pocket lies ahead. What's your call on the perceived slowdown for these two?
So when you look at the overall BFSI sector, banking, NBFC, across the board, obviously the last 1.5 months have not really been good. And the stocks have kind of across the board buckled despite the results actually being either in line with expectations or ahead of expectations. And I do believe, that when you look at the coffee can philosophy and the way we look at markets, which is to invest in quality names and invest in names from a long-term perspective, then this is the right kind of time to look at these. There have been certain pockets of concerns, like you said, which have started emerging out, which is probably on extra provisioning coming out because you're a little cautious on the retail loan book now. Across the board, the commentary going forward has not really been encouraging. But the question to ask at the moment is, then are these factors structural in nature or are they more cyclical in nature? Are they here to last for the next 2, 3, 4 years, or is it like a 1 or 2 quarter phenomena? And if you do believe that these are more cyclical issues, these are more temporary issues, then I think this is a time to use this as an opportunity to actually build up a position from a long-term perspective across the board in the consumption sector and in the BFSI sector, provided the quality of the company is great.
Manish, you have been a consumer analyst for bulk of your career. Of course, now you are handling the portfolio, and which has a large flavor as consumer. Let's talk about one large section of within the consumer auto space. The stocks have been beaten out of shape, and surely so. The numbers are weak, and the cycle may have have turned now. But is value emerging now? If one were to take somebody who always wanted to have Maruti but never did not want to chase the stock, it was 10,000 rupees. Correct. Now almost at 5. Do you think it merits to look there, or you think their businesses will be ruptured for good? That's what the market is feeling.
So when you look at the auto sector, what you very rightly pointed out is the fact that everything that we could have perceived to go wrong in the sector has actually in fact gone wrong in the last 1 year or so. So it all started off with the cost of ownership going up, the insurance charges going up and the insurance norms changing, and then now with the NBFC crisis, the registration charges have kind of gone up. So pretty much everything that could have impeded demand has actually happened, and which is visible in the stock prices across the board as far as the auto names, 4-wheelers, 2-wheelers are concerned, and the P multiples as well, right, which have kind of fallen off the cliff. Now, again, taking a step back, if the company is right, if it is proactive, if it is working for the future, is ready or preparing for an electronic vehicle, you feel the brand equity is right, the management is clean, and you feel the multiples have kind of started hitting the right levels, which we do believe, that value is starting to emerge in pocket across the board in the consumption sector now, then I think this is a time actually not to panic, not to sell, but actually to invest more and build a position from a long-term perspective. Remember, history teaches us a lot. So if you go back in history and look at the last 20, 25, 30 years, whenever something has gone wrong, there has been a major macroeconomic concern at the India level or global level which has emerged out. If you would have built a portfolio at that point of time across the board with blue chip names, you would have realized the amount of CAGR returns you would have made would have been far more exponential. It could have been the global crisis in 2008. It could have been Vajpayee government losing election. It could have been demonetization, right? Across the board, values do emerge in these times. And the fact of the matter is not to panic, to try and break the cycle of greed and fear, and to build up positions from a long-term perspective.
Right. Manish, talk to us about consumer space and the commentary which is coming in. Just moments back, Godrej came out with a decent set of numbers. They had guided the market lower so much that there was a positive reaction. There was, of course, a margin expansion as well this time. But if one were to, just analyze the commentary coming from HUL, Godrej, Britannia, and the same like, how are you analyzing the outlook from here on? Because that will determine whether stocks are expensive or have they started becoming attractive.
It's a great question, actually. And, the first point here is that we are always kind of wiser in the hindsight. Now, when you look at the third quarter results of FY19, the numbers were fantastic. It was probably the last 12, 13 quarters that we had seen the highest volume growth across the board from all staple companies. And the commentary when you saw at that point of time from everybody was pretty much across the board positive. And now, as soon as the fourth quarter numbers, came out, and we did see a certain bit of a climb down as far as the trajectory of growth is concerned, the suddenly commentary turned bearish, and people were incrementally more negative on the rural growth, which was growing faster than the urban growth, has now fallen off the cliff, and the guidance, forward-looking guidance kind of became bearish from pretty much everybody across the board all of a sudden. And what it did was it kind of brought the overall expectations down in the markets very dramatically. So when you look at getting into Q1 results till about 15 odd days back, nobody was really expecting anything, at least from the staples part of the overall consumption basket in terms of volume growth, in terms of numbers, anything. And like you very rightly mentioned, it's not just about one stock, but across the board, when you look at all the names that have come out with results in the staple space so far, the results have either been ahead of expectations or they have been by and large in line with expectation. And when you look at a 2-year CAGR of growth, the trajectory of growth has not only held up, but it's actually accelerated in the last 6 to 8 quarters pretty significantly and is holding up at those accelerated levels, which basically, makes me believe that the overall demand consumption at the retail level, at the consumer level, is not all that bad. It's getting pulled back, it's getting impeded at the discretionary part of the consumption more because of the structural overall macroeconomic issues that you are facing, which are in terms of the NBFC crisis, which is in terms of channel financing available and all of that. And when those issues kind of resolve, the demand pullback which is going to happen is going to be of a much greater intensity. And from that perspective, I remain optimistic on the overall consumption space in India from a long term perspective.